Debt is a ticking clock operating in the background of your financial life. Depending on how you use it, that compounding mechanism is either steadily building your net worth or quietly destroying it. The math divides debt into two distinct categories. Good debt is capital borrowed to acquire assets that go up in value or generate income, like a mortgage or a student loan for a high-earning career. Bad debt is borrowing money to consume depreciating goods, like high-interest credit cards used for vacations or clothes. The line between the two often blurs because of a psychological phenomenon called lifestyle creep. As your income rises, your brain quickly rationalizes a higher baseline of spending. A promotion at work suddenly makes a larger car payment or a more expensive apartment feel like a necessity, instantly consuming your new cash flow. People rarely fall into a financial hole because of one massive mistake. It happens through slow, daily conditioning that turns borrowing from a temporary tool into a permanent crutch. But your personal spending habits are only half the equation. The actual cost of the money you borrow is dictated by external forces operating far above the individual consumer. In the United States, that cost is controlled by the Federal Reserve. This central bank serves as the engine for the economy, raising or lowering benchmark interest rates to speed up or slow down financial activity. This chart maps how those policy decisions hit your wallet. When the central bank raises its benchmark rate to fight inflation, it becomes more expensive for banks to borrow money. They pass that cost on to you, causing interest rates on consumer debt to aggressively spike. If you carry a balance during an inflation cycle, your monthly payments increase even if you haven't bought anything new. A personal financial crisis is often collateral damage in a central bank's war on inflation. This vulnerability applies to companies just as much as individuals. Highly sophisticated businesses fall into the exact same debt traps. A business reaches a critical failure point known as over-leveraging when the loans it takes on stop generating new revenue. Instead of funding expansion, the borrowed money is burned just to keep the lights on and pay the interest on previous loans. You can spot this structural failure through a few distinct red flags. The first is when commercial lenders demand expanded personal guarantees from the founder. When a bank asks an owner to put their personal home on the line to secure a routine operational loan, the business itself is no longer absorbing the risk. The second red flag is a total lack of liquidity. A company might look highly profitable on an annual spreadsheet, but if it is chronically short on the actual cash needed to meet Friday's payroll or pay its vendors, the debt burden is choking the operation. In the corporate world, excessive borrowing acts as a mask. It hides a failing business model right up until the exact moment the cash reserves completely dry up. Whether you are running a business or managing a household, escaping the cycle requires choosing between two distinct frameworks for repayment. This animation illustrates the Debt Snowball method. Here, you ignore the interest rates and focus all your extra cash on eliminating the smallest balances first. Clearing an account completely off your ledger provides a quick psychological win, giving you the momentum to attack the next target. Now watch the same chart reset for the Debt Avalanche method. This approach attacks the loan with the highest interest rate first, regardless of the total balance. By knocking out the most expensive debt, you mathematically minimize the amount of total interest you pay to the bank over time. The two methods require a choice in how you view your own behavior. The snowball optimizes for human motivation and dopamine. The avalanche optimizes for cold mathematical efficiency. The best strategy is the one you actually stick to. If checking off small wins keeps you disciplined, you use the snowball. If paying a single extra dollar in interest bothers you, you deploy the avalanche. Once you clear the immediate liabilities, the goal shifts from reactive tactics to building proactive, permanent structural defenses. This scale visualizes the debt-to-income ratio, a benchmark lenders use to determine your solvency. You calculate it by dividing your monthly debt payments by your gross monthly income. If your obligations consume more than 36% of what you make, you are entering a zone that limits your ability to borrow for actual wealth-building assets, like a home. Protecting that ratio requires a liquid emergency fund. Keeping 3 to 6 months of living expenses in cash ensures that a sudden medical bill or a job loss doesn't force you back into relying on high-interest credit cards. True wealth is rarely determined by a high monthly salary. It is defined by building a mathematical moat that protects your income from the corrosive friction of leverage. Debt is a mathematical state, not a permanent identity. It can be engineered away. The sheer weight of multiple balances often causes psychological paralysis. Taking the very first active step to pay down principal, no matter how small, shatters that paralysis. Financial freedom is not an accident. It is the inevitable result of matching psychological discipline with a calculated mathematical strategy.